Hey, welcome everybody. This is another edition of Think with a Drink. This is the fun and fact-filled show brought to you by the ARIES Foundation for Financial Education. This week, Craig, we've got this one we used to call it the 3 Ps, but we'll call this Plan, Protect, and Pay. It's really about understanding the ins and outs and sort of a little bit about what's available as far as long-term care coverage is concerned, as somebody is sort of aging towards thinking about that type of coverage.
Okay.
And we're going to go through the ins and outs as why you should be thinking about that coverage and what that really means.
And maybe even when.
Yes.
Okay, great.
Real quick, a little bit about us. My name is Tom Alessi. I am the president of the ARIES Foundation. I have been doing this for 25 years in financial services. I am an investment advisor. That just means that anytime I'm sitting down with somebody, I have to act in a fiduciary capacity if I am giving any guidance or advice. I want to invite my vice president into the conversation. Craig, if you can introduce yourself.
Sure. So I'm Craig Richardson, the vice president of the ARIES Foundation, and I've been doing this a little over 20 years myself. And I specialize in working with families and individuals to help them define their financial goals and have a better relationship with their money.
And Craig will be chiming in as we go along through this presentation, as he always does. A little bit about the ARIES Foundation. You can find us on the web. ARIESfoundation.org. We are a nonprofit located here in Newton. The mission behind the foundation is trying to help everyone have a better relationship with their money. Because whether you realize it or not, you're in a relationship with money. And just like every other personal relationship that you might have in your life, there are behaviors and triggers and things that can cause us to act, well, a little irrationally sometimes when it comes to dealing with our money and our finances. That's all myself, Craig, the rest of the ARIES team tries to do is help everyone take a little bit of that emotion off the table. All right, so let's get into this because there's a lot that we want to try to cover in this episode in terms of dealing with this. Oh, I forgot the fun part. Look at me. I'm walking right past the fun part.
You're so the long-term care is going to be so much fun. You just went right past the alcohol. It was just
right past it. Okay, so the whole concept behind Think with a Drink is that we try to make some of these conversations, like the one today, long-term care. Like nobody wants to talk about this, right? Nobody wants to have any information about this. Try to make it a little bit less challenging, a little less daunting, more casual, more relaxed. And we can't think of a better way to do that than if we're having something to drink while we're trying to have that conversation. Today's drink, what we're having, this is this is from Castle Island Brewery in Norwood. This is called the White Ale. Now the White Ale is a Belgian wheat. You know, if you think of some of the other Belgian wheats out there, you know, sort of like Blue Moon, that type of thing.
I love Blue Moon.
So similar, this is one that definitely right in that same range, has some coriander in it. So it's, you know, a little bit of somewhere in the 5s as far as the ABV. So not heavy.
Right.
Again, meant to be more of that casual, easy sipper on a quench your thirst on a hot day type of thing, right? So anyway, for those who are or can, you know, sip along with us, scroll. All right, let's get into this. Concerns and needs for planning, right? So what is the real fundamental behind all of this, right? So when you look at it, you know, really, and there's a lot of words on the screen, so you know we'll be careful with that in terms of going through. But the reality is, for most people, the conversation about having to need care or having to go into care, we're calling that it,
right?
Is that it is never going to happen to me.
Correct, right. So,
go ahead.
I would say, it's the same conversation you have with life insurance, disability, anything bad. It always happens to other people. It's not my problem.
Right.
And I don't want to address it. It's no fun to talk about anyway.
Yeah. And, you know, or someone else is going to take care of it for me. And that's the real conversation, like when you start talking about, well, you know, hey, doesn't the government take care of this? You know, not Medicare. Medicare doesn't do that. What about Medicaid? Medicaid doesn't really do that either. You have to be in a skilled nursing facility to have that happen. So
Well, there's also a few other conditions that are not pleasant.
and, you know, look, the conversation we have with a lot of people is that, you know, my family is going to take care of me. My kids are going to do that.
Sure,
And then the conversation is, have you had that conversation with your kids?
of course not.
No, for the most part. And so what we try to say with this is this really isn't about, say, long-term care insurance itself, but it's more about the idea and concept of how am I going to plan, should it happen, and plan for the likelihood of having it available or paying for that care if it's needed.
Absolutely, yep.
Okay, so next slide. All right, so, and I'm going to ask you to hold the slide for a couple of minutes because there's a lot of words, and again, it won't be like this for most of them, but just because it's there. So if you can pull that slide up again just to make sure it stays on the screen for a little bit, thank you. So here's the reality for everybody as we go through this. The likelihood, someone over the age of 65, 7 out of 10 are going to need some kind of care.
Right.
Now that's a statistics that's coming from the Center for Medicare Studies. That's 70% of the population.
Right.
So 70% of the population is going to need some kind of care. Of that, 18% of them are going to need to stay in some form of a care facility,
Right.
not at home, which is another part of it.
So this is care outside the home, 18%.
18% who need care outside of the home. 20% of the 70, again, with that number, are going to need care for more than a 5-year time period. Now that, when we start peeling that back, when you're talking about that there's 10,000 boomers every single day,
Right.
who now are past the idea of turning 65, they're turning 75. They're going to be turning 80 soon.
Wow.
By 2030, the entire baby boom generation will be over age 65.
Right. Wow. That's a big statistic.
That is a silver tsunami that is coming, right? And, you know, the other statistic that's on there is that 56% of middle-income boomers, those who are in the middle class, if you will,
Right.
believe that either Medicare, health insurance, or some form of thing that's being provided
Right.
is going to cover those expenses. And that's not the case.
Right. That's true.
So again, this isn't meant to bum anybody out or really bring you all down here, but it's the reality of why this needs to be a conversation. It's the reality of why we have to look at this. And the last part on there is really the biggest part, Craig, which is that there's two main reasons why somebody would do this. One, I want to choose where my care is.
Right.
You know, the statistic, and we did this, you can look it up, it's one of the shows that we did, which was, why can't I stay here, right? You know, why can't I stay at home? Because that's where everybody wants care. They want to stay at home. They don't want to be in a community or in a facility anymore.
Right.
And the other is, so you want to be able to choose, and then the other more telling is that they don't want to be a burden. They want to stay independent, and they don't want to be a burden on their family. For all of those people who said, my kids are going to take care of me.
Well, I want to be a burden to my kids.
Okay, there you go. So I hope that they know that. I won't give you kids' names, but in terms of, I hope that the kids know that that's the situation. By the way, I'm going to send this to you. Dad wants to be a burden on you, just so you know,
Yes,
in
I'm
terms of
planning on
dealing
being
with
a
that.
burden.
But I mean, the reality there is, a lot of that is just, this is the whole, hey, it's not going to happen to me thing.
Right.
Right? You know, that's 70% of the population. If you're a couple, the reality is one of you is going to need some kind of care. And have you addressed it? Have you done anything to try to deal with that? And that's really what this whole thing is about.
Well, the other thing we don't talk about a lot either, and you're seeing it right now happening, is that you're seeing more and more of these care facilities opening up because the demand, the need for care is so great. Right. So what does that typically do when the demand is high? It increases the cost.
Right.
Right. And so even if these other plans were paying for it now, how can they afford to do it later?
Yeah.
So
Right.
I'm going to need another beer by the end of this one.
Yeah. We should have probably had something stronger than just a Belgian wheat. All right, next slide. All right, so this question gets asked a lot, and you know, this is really not trying to peg a hole or put somebody into a certain spot, but the reality is, you know, when should you start thinking about having a long-term care plan? Mm-hmm. You know, certainly if you're in your late 40s, early 50s, mm-hmm. that's the time. Most long-term care policies are purchased in the mid-50s because a couple of things happen. We get older, and as we get older, it gets priced to be more expensive.
Yep.
And also our health starts to fail. Mm-hmm. So we get sicker or weaker, or you know, and those are factors when it comes to what does something cost. So a lot of times,
or if you can get it at all.
Right, or you don't qualify for any type of coverage, and you know, that becomes problematic if we're trying to do it. Mm-hmm. But it's something that we hear a lot, you know, whenever we go through this, which is, you know, oh, I've heard it's expensive, or you know, my nana or my aunt tried to get it, and it was, you know, they said it was really expensive, so they didn't do it. Because most of the time, most people are looking at it, they're looking at it at age 65 or age 70. Like when now I'm thinking of it.
Right. I've crashed the car, now I want insurance.
But I'm older, I'm unhealthy, and now I want to get this thing. Well, of course it's going to be more expensive because it's so difficult to try to qualify for. And mm-hmm. we'll touch on that in a little bit. But I mean, that's the reality of what happens here, is that the younger you are, the more likely, the less expensive it's going to be.
Right, right.
Now, the flip side of that is, yes, you're going to be paying for it longer because care needs usually don't pop up until we're in our late 70s, but...
Well, but there's always exceptions, right? I mean, I unfortunately have worked with many clients who have been the exception, where, you know, an illness can pop up at any age. Well, likely to happen as you get older, like I said, because our bodies start to fail and more of these things happen. But, you know, 50s, 60s, you know, I've seen people have unexpected illnesses that they just didn't see coming.
Right.
That can end up being a care situation.
Yeah, absolutely. So it's interesting with that, with the graph behind us, you know, it says 55, but I will tell you there is a line in the sand that generally is age 60. So if somebody is considering or looking at or purchasing or wanting to purchase long-term care coverage, that usually it's done by age 60. Mm-hmm. And literally they've either looked at it and said, well, this is not for me, I'm not going to do it, or like Craig said, you know, hey, it's not going to happen to me, or they've decided to purchase it. So it's literally a delineation that pretty much across the board it's by age 60, because what happens at that point, the prices start to go dramatically up, and that's when we start to get that it's very, very expensive. Mm-hmm. Well, yeah, because they know that you're going to need care, so that's why.
Right.
Next slide. All right, so now we're going to get into a little bit deeper in terms of the conversation, and this is going to be about literally the different types of coverages that are available, the solutions that are out there on the street.
Okay.
And sort of the back and forth with these in terms of, let's call it, I think we did it on the slide and called it pros and cons for each of these different types of coverages, because they all have their space or their place or the person that it fits for. It's not very cookie cutter. You can't just say, oh yeah, everybody fits in this box or everybody fits in that box.
So it's not a one size fits all type deal?
You know, I don't, no, it shouldn't be, right? Because that's the first thing, is it really shouldn't be a one size fits all for any of this.
Right.
But it's all about what you're trying to do, what's the game plan, you know, what's the family history like, what's your health currently like, what does that mean in terms of what can I afford, those type of things that come into it. Mm-hmm. Before we start and before we get to the next one, as we've sort of already talked a little bit about, one of the things with long-term care insurance, just as a general blanket statement with it, is this is like the hardest thing to qualify for. And the reason for that is not only does it take into consideration your age, mm-hmm. your health, mm-hmm. it takes into your activity, how much active you are, right. how active you are, mm-hmm. and also takes into your mental acuity.
What?
Yes.
Oh, I already can't get it then.
So there's a lot of factors that get rolled into this when people go to qualify or go to get, somebody says, hey, I really want to get this, I really want to do this, and then like Craig said earlier, they come back and it's like you get disqualified because one of those things didn't go through. And it became a problem in that situation.
Yeah, I've had real life situations with this where I had a client, he had a lot of assets, but he wanted to protect those assets for his family. And we talked about putting long-term care in place, and at the time he said, yeah, I think I'm all set for now. 3-4 years later, the guy calls me up and says, Craig, can I still get that long-term care? I said, yeah, I'd love to sell it to you. What's going on? Just got diagnosed with dementia.
Right.
You're out.
Right. Trip the wire, you can't do it.
Right, so.
No, not happening. All right, so let's go into the first one. Right, so this is what we'd refer to as, your parents, the next generation, what we would call, and if you could pull the slide up for that, standalone. Oh, this is the different types. I'm sorry, I'm breaking them all down for you now. So. See, it's because the slide didn't pop up for me. So we'll basically go through what is referred to as traditional or standalone long-term care. Then we'll go into what they have now, which are these hybrid models that are life insurance based. One of them is individual, one of them is joint, and one of them is an annuity hybrid. So we'll touch on each of these. Again, the pros and cons, why they make sense, who they might make sense for, and how that works. So let's go to the first one now that we've jumped through that mental hoop there of trying to do it.
Did you pass the acuity test? Okay.
Yes. All right, so traditional long-term care, and this is the long-term care that you probably, if your Nana had it or your aunt or somebody, your parents might have it, this is traditionally what has always been around as long-term care coverage, right? So basically, it would cover pretty much anywhere you wanted to cover. And when we say communities, we mean home, assisted, skilled nursing, hospice, right? Okay, so cover you across all of them. It's very, very flexible in terms of how much coverage you want to get, right? Just number of
what's your budget, right?
How long do you want it to be? How much do you want to cover? All of that's fairly flexible. I will tell you though, in today's world, you really probably about shuts off after about 5 or 6 years. You really don't have too many standalone traditional policies that will go longer than that.
Because they're trying to cap their coverage too, right?
Right, they're trying to cap it, right? So the premiums in this case, they're pretty much, it depends on what you're trying to do with it in terms of going through. And if you could pull the slide up again, just so we can start on the con side, right? Basically, with one of the last pros there, it says that you can have somebody pay for it. You can have a family member give you care and have that pay for it, right?
Yeah, absolutely.
Depends on the policy. There is a tax benefit as well.
So it can be a burden to my kids and they can get paid at the same time, right?
Correct. Be a burden and give them some money for it. But the tax deduction depends on where the tax codes are. At this point right now, you'd have to be over and above a certain amount. But if you're paying for the care, you probably are and could get that deduction. All right, so the cons, and the biggest con of all with it, and the biggest negative and drawback with traditional long-term care coverage is use it or lose it. This is just like homeowners coverage, it's just like your auto insurance, it's just like term insurance. I have it. If I never use it and I pass away, I paid for it and I got nothing but peace of mind.
That's right. That's why I crash my car on occasion, just so I can use it.
Yeah, you just want to ding a bumper or something, or chip the door, just so you're getting your money's worth of it, right? The other is that you have to medically qualify, right? Like I said, this is one of the hardest things to ever qualify for, and it's very, very difficult, and they will hit you with additional premium cost for doing it. And then the last one really is that, and this is probably the biggest burden that's gone on for most generations, is that the premiums are not guaranteed. And what's happened in the industry, certainly over the last 10, 15 years, is that all of these carriers have gone back to their premium holders, to the policy holders, and said, we're going to hit you with an increase.
Right.
And that increase has been 10, 15, 20%. You had carriers asking for as much as 70% increases in the cost. So this is why it has this problematic issue with it, because now I'm somebody who's been, Nana's been paying this for 20 years, and now suddenly they said, oh, Nana, you got to pay 50% more, keep the same coverage.
Well, when they did it originally 30 years ago, they thought it was going to be like term insurance, and people would carry it for a while, then they would drop it. What they found is no one ever dropped it.
Right.
And also now they had to pay all these claims on policies, and they weren't expecting to pay that many claims. So what they couldn't do is they can't cancel the policy, it's contractually yours.
Correct.
But what they did have the ability to do is do across all classes increases in premiums, which pushed people out.
Right. All right. So, as far as next one, we'll go from here into a life insurance hybrid, right? So basically, what the industry did, and the industry said was, what can we do to make a change to this? Well, the first thing that this does is this changes the use it or lose it, because it's a life insurance contract. So if you don't use the long-term care benefit and you die, somebody's going to get it.
Right.
Right?
Yes.
You can use it in all the same facilities, just like a traditional policy. So at home, assisted, skilled nursing, hospice, all the same thing. You have the same ability with depending on the policy, who's put it together, the ability to get that deduction possibly on the premiums that's possibly there. Right? For a lot of them, that premium is guaranteed.
Right. Once you start playing it, that's it.
Right. They lock it in. There's no changes that are really going to go on with that. Right. The problem with this is we get back to the whole coverage thing about, hey, needing to qualify, and like how much is that really helping me, because this is life insurance now, so we're taking that on there. Again, a lot of times there's limited funding to these. Means I only can pay over a certain period of time. I can't pay for the rest of my life or until I go into coverage. At 5 years, 10 years, 20 is probably like the max that comes up with it, which just makes it a little bit more expensive
on the front end.
On the front end in terms of trying to do that. So, there are factors where this is definitely beneficial, certainly over and above, because you solve the use it or lose it, you solve the guarantee part.
Someone's getting the benefit.
Right. And there's usually a cash buildup, so you have cash that you can use as well. So you have one, two, or three. The money's going to get given back some way, shape, or form in terms of that. But you got to qualify. So what if we have husband and wife, and one spouse is healthy, one spouse is not so healthy, or probably questionable whether or not they're going to make it? You run into an issue there. Well, it's okay, great, we can put it on one spouse, but the other spouse goes into coverage, they're going to drain all the assets, and then we didn't do any good.
Right.
Next slide. So we bring in the idea of doing this as a joint policy. And a joint policy in life insurance just means second to die, right? So basically with the life insurance, it says, instead of I'm just insuring one life, we're now going to insure two, which for life insurance is a much better thing for the company, because now we don't pay out until the second person dies.
Right.
First person could die in 3 years and the other person lives for 25. We're not paying a death benefit for 25 years. This is a win-win for an insurance company, right? So, but in the great grand scheme of everything, what you get there is the ability to put that second person, if there's a spouse on there who's a little bit questionable, then you can put it on there, and you can probably get away with getting both covered under it at probably a lesser cost.
Right, and you don't have to wait till one dies to be able to take advantage of the long-term care coverage. It's covering both people, right? And makes it a little bit easier probably to get the person who's a little bit
right
onto the policy to begin with.
Next slide. So now we go sideways with it, and we put it into what this one says, annuity IRA hybrid. And this is just taking, because a lot of times what happens is most people have two big assets. They have their home and they have their retirement account. And this allows the ability to take the individual retirement account, put it into an account or a portion of it into a long-term care policy, and if we have husband and wife or two spouses, now we can cover both of them with the same bucket as far as going through that. The distributions that come out are taxable because they're IRAs, but if you're paying for long-term care and it's over and above the percentage that's there, which it will be because you're paying for long-term care, you're going to get a tax deduction on it.
So you're paying tax, then you're deducting, then you're not paying tax. So
Correct.
it washes out that you're not paying tax.
Washes out. And then one real big thing with that one, it's a little bit easier to qualify because they don't have the other component to it. You don't have the life insurance piece on it, so you're not going to get as involved or detailed. There still are some knockouts in terms of going through it, but that's just something entirely in terms of looking at
Well,
it.
it's also because you're sharing risk on those products.
Right.
You're spending your money first, and if for some reason you drain that bucket or that time period goes by, then the insurance company comes into place.
Right. So, next one. All right, so, just understand that every single person's situation is going to be different. That's why we said there's a whole bunch of different things out there. It's just a lot of times we talk to folks and they think there's only one way to go.
Yeah, sheet of ice. No, you can't do that anymore. Just
Push them out into the snowbank.
It's not knife ice anymore. We're melting it all.
Right. But just know that there's a whole lot of different options. There's a lot of different strategies. Don't just try to think like, one of the things that most people try to do is they try to self-fund this. And there are ways to leverage it, and there's ways to leverage it with portions of your assets, not all of them, to take care of it, because you're going to have some other things that you can do and deal with. So that's a big part of it. So just know it depends on you, what you're trying to achieve, the goal you're trying to set, what happens, but that's what's really involved. So next one. All right, so for us, for anybody watching, if you're watching, take your phone out. If you click pause and just stop at that QR code, that's going to open up our scheduler. We're happy to have a conversation. If you've thought about this, if you're concerned about long-term care or have a family member who is and are unsure where to go or what to do, reach out to us. We're happy to have the conversation. We're happy to try to answer questions, try to give you a little sense of, hey, this is what's available, this is what's in place, this is what you can do. Okay, so just use that QR code, reach out. We're happy to have a conversation. There's no cost, there's no obligation, reaching out to the foundation. Next one. If you ever want to check us out, like we said, ariesfoundation.org. You can info at ariesfoundation.org is the email. Check us out on social media, whatever you use, like us, follow us, friend us, whatever it is that you're supposed to do on social media, but go through all of that. Check us out here on New TV, check us out on YouTube. We've got all sorts of different things available. But reach out, because we're happy to have a conversation with you. And on that one, we're going to finish the white ale here and say, skål.